Hey, Lance Morgan here, and I am so excited to share with you our training on the retirement restoration. This is by far my favorite training because it has the biggest impact on the lives of our clients. All right, so triple compared to what? If I'm going to show you how to triple your retirement income, triple compared to what? What are the traditional retirement strategies that we are trying to beat? Okay, so let's talk about Retirement 101. Here's Retirement 101. You start here with no money. You save until you have enough money to retire. You then spend your money in retirement, and then when you run out of money, you die. How's that sound? Pretty simple, right? Save for retirement. Once you get enough money, okay, you spend the money in retirement, and then you die. Okay? What's the problem? What's the problem with this situation? Now, if you die over here, you're fine, but what if you die over here? Okay? Kind of messes up the plan a little bit, doesn't it? And that is when they came up with what we call the 4% rule. Here's how the 4% rule works. You're saving your money until you get enough to retire. Now, you might get a 10% return during your retirement years. Maybe not, maybe so. That's not the point. The point is that you eventually get enough money to retire. But now you might be a little bit more conservative. You might shift this aggressive kind of investing strategy to something more conservative. Maybe something that's going to get a consistent, steady, conservative 5% return. Then you're going to pay 1% to your financial advisor on average so they can go golfing every day and get that residual income. That gives you 4% to live on. That's where they came up with the 4% rule. You can Google it. There's a lot of people talking about it. But the idea is that you are living on the interest. You're spending your interest. Now, you may want to keep 20% of your money over here, and maybe you only put 80% of your money into these fixed accounts. You may do a little bit of something like that, but in general, you're going to be shifting in retirement. You're going to be shifting from more aggressive investing strategies to less aggressive strategies and try to live on the interest. Why? Because then when you die, you have the same that you started with because you're living on the interest. Okay? So your account isn't going down in value. Your account is staying level and you're living on that interest. So if you had $1 million at retirement, that $1 million would pay you $40,000 a year. That is the 4% rule in a nutshell. Okay? Now, there are 4 variables to consider with the 4% rule. First of all, stock market crashes, bond rates, inflation, and taxes. So, stock market crashes, stock market uncertainty. As you're growing your money for retirement, there's a lot of uncertainty. If you remember back in 2008, people had to delay their retirement for 10 years to get their money back before they could retire. Okay? Unless they timed it just right. But we've had a lot of ups and downs. So you might be getting close to retirement and all of a sudden lose half your money, and then you have to wait to get the money back. That can really mess up your retirement plans. That's a big uncertainty. How about bond rates? Have bond rates always paid 5%? No. Back in the 80s, they were even better than that. But we've had a lot of years recently where we were not earning 5% on bonds or CDs or anything that was safe. So to try to live on 5% minus the fees, 4%, it was more like the 2% rule. Okay? So for a long time, it was maybe like a 2 to 3% rule. That is also a huge variable to consider with the 4% rule. How about taxes? Did you know that way back in the day, in the 50s, the upper income tax bracket was taxed at 91%? Or how about during the 70s and early 80s, everyone in that high income tax bracket was taxed at 70%? Now, luckily, taxes have gone down, But do you think taxes are going to continue to go down? Or have you looked at our debt lately? Have you looked at the national debt? Do you think it's possible that taxes could go up in the future? If taxes go up in the future, you're going to potentially be paying more money in taxes in the future if you have money in an IRA or a 401k or any of these qualified plans where the government owns part of that money. So you are going to have to give some of that money to the government, which means that you may not be able to live on $40,000 a year out of your $1 million. You might only be able to live on half of that if they take half of your money in taxes. That's just a big variable, something to consider if you have money in an IRA or a 401k or something like that. So let's review. Here we have our money growing to retirement. How is it going to grow? Are we going to lose the money in the stock market and have to wait? Okay, so that rate of return is a big variable. Once we start to spend our money in retirement, are we really going to get 5%? That's a big variable, right? We've got stock market crashes here that we might have to recover from, okay? We have a big variable here with bond rates, okay? Inflation. If our income stays the same the rest of our lives, what about inflation? How are we going to keep up with inflation? We need our income to be able to go up, to be able to keep up with inflation. That's a big variable. That's a big problem. And what if our actual take-home amount goes down because taxes go up in the future and we're able to live on less? Another big variable. These are all things to consider with the 4% rule. Okay, so we're going to break this down into two phases: the growth phase and then the income distribution phase. So let's talk about the growth phase. First of all, let's go back here. So the growth phase is from here to here. So starting here till we get to retirement. This is our growth phase that we're going to focus on first. Then we're going to focus on this phase next. So we're going to break it down into those two phases, okay? All right, so you've probably heard of the rule of 72. If you haven't, you can Google it. But basically what that says is that you take 72, the rule of 72 says take 72, divide it by the interest rate that you're going to earn on your money, the rate of return that you're going to earn on your money, and that will tell you how many years it takes to double your money. Okay? So if you take your calculator and you take 72 divided by 10%, that means our money will double every 7.2 years. Okay? Now, let's take a look at why that might not be always some sound advice to follow. Okay, so here we have the stock market history from 2000 to 2022. Now, the average rate of return has been 5.9%. So we take 72 divided by 5.9%, and our money should double in 12 years. So we have $1 starting out in 2000. After we have the first little drop of 9/11 and the dot-com crash in here, our money dropped in the stock market, as you can see, 46% if you had your money tied to something like the S&P 500 index. That means your dollar actually turned into 60 cents. Then we finally had some good years leading up to the recession of 2007 and 8, but our 60 cents got back to our dollar. Now we're a long ways from doubling our dollar. We're still at even. We're still even at $1, right? Then we lost the money again in 2008 and we're back down to 60 cents. We then grew our money again. Let me scroll this down a little bit. Okay. After 2008, in 2011, our money was growing and we almost got to our doubling of our money right around here in 2019 is when we finally doubled our money. So what happened to the rule of 72? Why didn't we double our money in 12 years? The average return says 5.9, but the actual return on the money was 4.26 because of the impact of losses. So it took a lot more time to double our money because we kept losing the money and we had to make up for those losses, okay? Now I'm going to dive into that in a little bit more detail in a minute, but my point of all of this is that there's more to growing your money than simply the rate of return. You can't just pull up a little calculator and figure out when you're going to be able to retire. There is way more to the rule of 72, okay? It's a lot more complicated than the rule of 72. There are 4 considerations. Number 1, yes, the rate of return. That is important. We're going to talk about that. But there's also the average returns versus the actual return on your money and the impact of losses, which we looked at briefly. We're going to look at that again. There's also taxes to consider. What if you're paying taxes along the way? You're not going to double your money if some of your money is going to taxes. How about fees? How much are you paying in fees? You're not going to double your money if you're paying fees, right? These are all things to consider. So there's 3 ways to grow your money when it comes to rate of return. Let's talk about rate of return. There's fixed, there's variable, and there's indexed. Let's summarize. Here's fixed. Fixed means you're going from here to here in a fairly straight line. This is your CDs, your bonds, your money markets, your savings accounts. Basically, just slow and steady wins the race. The tortoise and the hare is kind of the analogy, right? There's whole life policies. There's various investments. But again, remember, it's not about the golf clubs. It's about the swing. But there's multiple products that are going to give you kind of a fixed rate of return. Then there's variable. Variable, most commonly, would be your stock market, okay? But it could be real estate, it could be gold and silver, coins, whatever the case may be. But there's some ups and downs. It varies. That's our variable. Then there's what we call the indexed, kind of a newer concept, which is where the money goes up, it flatlines, guaranteed to never lose, and then it can go up, so it looks a little bit something like that. So you get to participate in the upside of the market, but you have no downside. So I guess you could kind of say it's kind of in the middle of the two. Okay, those are your 3 options. Now, since most people are pretty familiar with the idea of growing your money in a fixed account and a variable account, I want to dive into this index strategy in a little bit more detail in case you're not familiar with this. This is how the indexing strategies work. What's going to happen is that the companies put most of your money into a safe conservative portfolio that on average is going to get around 5%. Okay? Then that is how they can guarantee you that you're not going to lose any money. But this is not how you could get a double-digit return, right? So how do they get you a double-digit return without any losses? Well, here's what they do. They take the money that you save and they calculate how much money would they need to save into this safe bond conservative portfolio that's earning around 5% to get you back to the $1,000 that you started with. Does that make sense? So they kind of work backwards to figure out how much do they need to save at 5% to get you back the $1,000 you started with. That allows them to guarantee you that you're not going to lose any money. Then what they can do is take $50 in this example, and they can put that $50 towards the stock market through what we call options trading. And they use options trading on an index like the S&P 500. That's why these are called indexed strategies, because they're buying an option on an index. Now, if you're not familiar with options trading is where instead of buying the index, so let's say that it cost you $100 to buy the index, but for $50, you could buy the option to buy the index in a year from now, okay, at today's price. In other words, you're buying a lottery ticket and you are gambling on whether or not you think that the index is going to go up over the next 12 months. If the index does go up over the next 12 months, you have the option to buy it at a lower price, which makes your lottery ticket worth a lot of money. So you don't even have to buy the index, you can just sell your lottery ticket. Now, depending on how much the index goes up will depend on how much your lottery ticket is worth. Okay, so let's take a look. So we take $1,000 plus our $100. If we turned our $50 into $100, that is $1,100 or the equivalent of a 10% return. That's a double-digit return without any risk of losing your original $1,000. Okay? Now, some of these companies are really good at this options trading, and you can watch YouTube videos on options trading if you want to learn more. But some of these companies are really good at these options trading, and they could turn $50 into $200. And that would give you the equivalent of a 20% return. Yes, it's very possible to get a 20% return. I've seen it many a times. Now, what if our lottery ticket doesn't win? What if the actual index goes down over the next 12 months? Who's going to want to buy your lottery ticket if it didn't win? It's not worth anything, right? So you're going to get a zero. You're going to lose that $50, but you're not going to lose the $1,000. Now, I want to give you one more scenario, okay? That is, of course, a 0% return. I want to give you one more scenario. What if we go back into an environment like the 80s where bond rates were really high, and even right now with interest rates really high? And what if we've got the market that is doing really well, like in the 80s? So what if we've got like the best of both worlds? What if we've got good rates on bonds and the stock market is doing well? Well, that's the best of both worlds for this particular strategy, because we may only need to use $900 in our account over here, in our bond account, to get us back to our $1,000. That gives us $100 to put into the options market. And on a good year, we might be able to turn that $100 into $400, which could be the equivalent of a 40% return. Yes, during the right conditions, these indexing strategies could get you these big returns without any risk of losing money in the stock market. Okay? That's how the indexing strategies work. Now, here's another way of looking at it. For those of you who have like an existing chunk of money, let's say you have some money in a retirement account and you want to move all of your money over into one of these indexing strategies. Well, if you do that, they're going to buy these bonds at whatever the current rate is. It's kind of like a one-time thing. It's not like a monthly savings. It's like a one-time thing. So it all depends on what the rate is when you move your money over. So if you moved over $100,000 into one of these indexing strategies, they're going to figure out how much do they need to invest at 5%, if that's the going rate at the time of the bonds. Okay, because what they're going to do is they're going to buy a 10-year bond. So they're going to figure out how much do they need to invest over 10 years to get you back your $100,000 that you started with. In this example, it's going to be $61,000. That gives them $38,000 to put towards the options. So that allows them to take that $38,000 and get double-digit returns on the $38,000. So the higher this number is, the better the overall performance is going to be. The lower that number is, the lower the overall performance of this type of scenario is going to be. Does that make sense? Okay, so you've got a couple of different scenarios. So this indexing concept can work if you're saving money every month or if you have a lump sum amount of money that you just want to move in one shot. Okay, this is basically what it would look like in an oversimplified way, but I want to talk about what we call the reset. Now, when you have money in the stock market and you lose money in the stock market, you have to wait for the stock market to come back to get you back to where you were before you lost the money. In the indexing strategies, you don't lose. Okay? You don't lose any of your money. So then, when the market turns around and comes back, you get the gain on all of your money. You didn't have to get out of the hole because you never fell in the hole. So every year it resets. Every year it resets. So in some ways, having the stock market crash can be a good thing for an indexing strategy because it usually bounces off the bottom and gives you a really good return the following year. And that good return could be on all of your money because you never lost any. So that's just kind of an example. Now, from 2000 to 2013, you could see how you could actually earn a lot more money in this indexing strategy than in something like the S&P 500. But of course, this is just looking at one little window of time. Obviously, there's a lot more to look at, but that's just to show you an example of how this works. Okay, so again, 4 considerations. We've talked about the rate of return. There's fixed, variable, and now index. So hopefully you're familiar and comfortable with all of those 3 different options. Now let's talk about average versus actual rate of returns and the impact of losses, and then we'll talk about taxes and fees. So let me ask you a question. If I could offer you a 25% average return, would I have your attention? That could solve a lot of your problems, right? Heck, you could probably triple your retirement income by getting a 25% return every year. That would solve a lot of problems, wouldn't it? Let me ask you another question. Would you rather have a 50% return on half your money or a 5% return on all of your money? Interesting, isn't it? Let's look at the average versus actual rate of returns. Okay, so here we have the actual versus average returns. So let's say that we're starting with $100,000. And again, remember, I offered you a 25% average return. So let's say that you give me $100,000. And in the first year, I lose 50% of your money. Sorry about that, okay? But I convince you to hang in there because next year is looking to be a really good year. And sure enough, okay, the next year we have 100% return on your money. 100% return on your money. Not a 50% return, 100% return on your money. But it's 100% on half the money because the previous year we lost half your money. So although you got a 100% return in the second year, it was a 100% return on half the money. However, if you ask your math teacher, down 50, up 100, that is an average of 25%. Now, yes, this is an extreme example to prove a point, but believe it or not, just a simple 5% every year, or actually a 0. Let's say that the first year, instead of losing 50%, okay? So in the first year, if we didn't lose that 50%, in the second year, we only got a 5%, not a 100% return, just a 5% return, we would still be money ahead. We would still be better off with just a 5% return because we didn't lose any money. That is the impact of losses and how they can affect your money. Yes, this is an extreme example, but in a minute we'll look at the actual stock market history. But this is just to prove a point of how actual versus average works. And here's the scary thing. A lot of financial institutions can sell products based on average returns. So you might get a product that has an average return of 10%. You do your little rule of 72 calculation, or you jump online to a compounding interest calculator. You think you're going to have lots of money for retirement. The next thing you know, you show up to retirement and you're a lot short. That's what you've got to consider, is how all of this really works. Okay, so now let's actually compare the actual rate of return of the fixed, the variable, and the indexing strategies. Now, the variable strategy is kind of hard, so I'm going to use the S&P 500 as a benchmark. Now, the reason is because even Warren Buffett says he can't beat the S&P 500. So I'm guessing that most of you are not consistently beating the S&P 500. Maybe you have a 401k, an IRA, money in the market. Maybe you have an amazing financial planner or a stockbroker who is crushing it and getting you way better returns than even Warren Buffett is getting. But for this particular video, let's just use the S&P 500 as a benchmark to compare the fixed, the variable, and the indexed. Okay, now to start with, I want to use the S&P 500 as our benchmark, but I'm not going to use the dividends because, like I said, most of you probably are not investing directly in the actual S&P index fund. So this is minus the dividends, but it's still going to be higher returns than most people are getting. I'm also going to take you down a little little history, a little trip down memory lane, and we're going to look at 1980 to 1999. Now, we need to talk a little bit about what was going on during this particular 20 years. This was when your baby boomers were hitting the peak earning years, and they started to take away their pensions. They started to replace their pensions with 401ks. It was also during the early 80s that Wall Street came out with mutual funds that allowed an average person to put $50 away into the stock market instead of only the wealthy being able to buy individual stocks in the stock market. So we had this perfect marriage. We had Wall Street's mutual funds that they put inside the 401ks. We had corporations that were getting rid of pensions and moving all of the focus to the 401ks, and we had the baby boomers reaching their peak earning years, and it was the perfect storm. The money just flooded the stock market. We had 25% returns. We had 14, 17, 26, 14, 12, 27, 26, and then we had Al Gore invent the internet, and what do you know? We had the dot-com boom. We had 34, 20, 31. By the way, I don't know if Al Gore really invented the internet. That was just a joke. But the point is in the late 90s, the market was going gangbusters, okay? During this particular 20 years, the average return was 14.67. The actual return was just under 14. Still really, really good. In fact, during that 20 years, if you had $1 to begin with, you would have ended up with almost $14 when it was all said and done. This is where buy term and invest the difference came out. This is where everyone wanted their money in the stock market. It was just the only place that people wanted to put their money. Okay? Now, let's fast forward a little bit and let's look at the last 23 years, starting with our first, let me go over here, our first little crash. We had the dot-com crash. Apparently, a website with a .com at the end was not worth millions of dollars after all. So we had the dot-com crash. We also had 9/11 in there. And if you had $1, it would have turned into, $1 would have turned into 60 cents. Okay? Fast forward, time goes on, over 23 years, the average is 5.9, but the actual has only been 4.26. So over 23 years, your dollar turned into $2.61. So during that particular time, let's say that we go with a floor of 5 and a cap of 5. That's just another way of me putting in 5% every year. We're going to call this a limited return because it's limited to $1. So we have a limited, 5%, sorry. It's limited to 5%. We're not going to get 13% returns. We're going to get 5. But we're not going to lose 38%. We're going to get 5. Okay? So, what strategy works best during this particular time frame? Believe it or not, your limited return, your fixed, this is the fixed strategy. Your fixed return would have done better. Now, in all fairness, let's take out the first couple of years there and let's start with 2003, where the market started off on a positive note of 26%. Let's just time it a little bit differently for that 20 years. Let's look at those 20 years. During those 20 years, the stock market, the variable returns would have done considerably better than the 5% fixed. Okay? Now, let's look at what we call the indexed strategy, which is a floor of 0. And the best way to kind of illustrate it in this software, and I can go into this in more detail later, but the idea is around 70% on the upside in general. So we're not going to get 13, we might get 9, okay? We're not going to get 29, we might get 20. Yes, you can get 20% returns and higher, okay? So in this example, we're going to have no losses, right? 0 is the worst we're ever going to get. Let me kind of clear this up a little bit. A lot going on there. Sorry about that. So we're not going to lose 38% in 2008. We are going to get a 0. Now in 2009, we're not going to earn 23%. We might only earn 16. But when it's all said and done during that particular 20 years, the indexing strategy would win. Now, let's go ahead and take out that 2008. Let's start with maybe 2009. Well, now during that 14 years, the actual variable strategy in the stock market would win if you are invested in something that is tracking the S&P 500. So there's a few variables there as well. All right, so my point in all of this is not to try to tell you which one of those three is better. I'm just trying to show you that it depends on the years and it depends on what you're actually looking at and what your objective is, okay? But there are 3 strategies to grow your money: fixed, variable, and indexed, okay? Okay, so back to our 4 considerations. We've talked about the rate of return. We just talked about the average versus actual returns. And now let's go ahead and dive into taxes and then we'll cover fees. So 3 tax categories. There's taxable, there's tax deferred, and there is tax exempt. Okay, so your money could either be taxed as it's growing, or it could grow tax deferred, meaning that you don't pay taxes while it's growing. And then there's tax exempt, which means you don't pay taxes when it's growing or when you take it out. All right? Let's talk a little bit about the tax history and dive into this in a little bit more detail. Okay, so let's take a look at the tax history. Over here we have the Great Depression, we have a lot of wars going on, we have lots of things happening in our history. But one thing we're going to focus on is that we have had very high taxes in the past, and we could potentially have high taxes in the future. If you are currently in a 20% effective tax rate bracket, all right, or an effective tax rate, not the tax bracket, but if your tax rate is at 20%, then if you have $100,000 in, let's say, an IRA or a 401k where you put the money in pre-taxed, then that means that you have really $80,000 and the IRS has $20,000. but it kind of depends on when you take the money out. So the real question is, what's going to happen in the future? Are taxes going to go down or are taxes going to go up? Because if taxes go up, for example, maybe they get up closer to our average line. If they get closer to our average line, then it's possible for the IRS to actually have more money than you do if your money is in what we call a qualified account where you deferred taxes until later. So maybe you want to pay your taxes now and get them out of the way if you think taxes are going to go down, or sorry, if you think taxes are going to go up in the future, you may want to pay your taxes now and get them out of the way. If you think taxes are going to go down in the future, then you may want to actually postpone your taxes until later. Now, you may have been told that you're going to be broke in retirement. You're not going to be making as much money, and so therefore you're not going to have to pay as much in taxes. Well, guess what? I'm going to show you 3 strategies to triple your retirement income. So if you're going to triple your retirement income, you could have a decent income in retirement, putting you in these upper income tax brackets, even in retirement. So you could still be paying a lot of money in taxes in the future, even though your kids might get out of the house, you might pay off your house, you might do all these things, you still could have a high income in retirement, therefore you might be paying high taxes. Okay, now I want to talk about what we call tax thresholds. This is very interesting. Let's take a look at this one. Now you might be saying, well, I am not in that top 1%. I'm not going to be paying a lot in taxes because I'm not in the wealthy category. Well, the taxes can be based on what we call tax thresholds. So way back to 1913, when the initial tax rate was at 1% to begin with, okay, you had to make over $500,000 to even be taxed at that 1%. Now, if we fast forward down here until we get into the 40s, in the 40s, they had raised the top tax rate all the way up to 81% if you made over $5 million. Now, I don't know who that was, okay, back in 1941 that was making over $5 million. Maybe it was one of the Rockefellers or something. I don't know. But watch what they did in 1942. In 1942, they raised taxes, but only 7%. They only went from 81 to 88%, but they lowered the threshold to be in that 88% to 200,000. We call that casting a wider net, okay? So they were casting a wider net to be able to get more people. They went from 5 million down to 200,000. Now, what else can we learn from history? Well, let's scroll down here and look at the Reagan years. During the Reagan years, okay, we had really low taxes, okay, but almost everybody was in the top income tax bracket because they lowered the threshold so low that even if you made $29,000 a year, you were in the top tax bracket. So there's a lot of things. They have a couple of levers that they can pull. They can raise the tax rates, and they can also lower the thresholds to be in those top tax rates. And now let's talk about what we call your effective tax rate. Okay, so the way your effective tax rate works is that if you make $250,000 a year as a married filing jointly with some standard deductions, your taxable income would be around $222,000. That puts you in the 24% tax bracket. However, not all of your money is taxed at 24%. The first $22,000 that you make is taxed at 10%. Then the $22,000 to the $89,000 that you make is taxed at 12%. And then from $190,000 from 190 to 364 is taxed at the 24% and so on. You get the idea here. So what we do is we kind of average it out, and that gives you your effective tax rate. So even if you are in a 24% tax bracket, you may only have to pay 16% in taxes. Okay, so the final thing I want to talk about with taxes is, should you pay your taxes now or later? One of the biggest questions a lot of people have. Okay, so let's say that our annual contributions to our retirement is $20,000 a year. And let's say that we are in that 20% tax bracket. And let's just say that taxes stay the same. Let's just say that when we take out the money in retirement, we are also in a 20% tax bracket. And let's just say that we have 20 years until we're going to retire and withdraw this money. And let's just say that we are earning 7%. That's our current scenario. The million-dollar question is, should we pay our taxes now or should we pay our taxes later? So if you have a qualified plan, a SEP IRA, simple IRA, a 403B, a 457, a 401k, an IRA, these are all what we call qualified plans where you get to put your money in pre-tax. The biggest misconception is that you get to save money on your taxes. Not true. What happens is that you get to put the money in pre-taxed, so that lowers your income and you pay less taxes that year, but all you're doing is putting $20,000 in, which is going to eventually grow to $877, but it's not all your money. Because you put your money in pre-taxed, you partnered with the IRS in your retirement. They own $177,000 of your retirement, which means your take home is $701,000. Now, here's where the big misconception comes in. If you decided to pay your taxes now, you're not going to invest $20,000. If you did invest $20,000 after taxes, then yes, you would have to pay more in taxes, but you're not. What you're going to do is you're only going to invest $16,000 because we need to pay $4,000 in taxes that year. So we're not paying more taxes, we're simply investing less, okay? So we're investing less. Now you might think that if you're investing less, then you're not going to earn as much compounding interest. That is true. You're only going to grow to $701,000, not $877,000, but it's all yours. You don't owe anything to the IRS. You already paid them the $4,000. You don't owe anything to the IRS. You get to keep all of it, which means it doesn't matter which one you choose. If taxes, whoa, dropped my pen. If taxes are going to stay the same. Now, what happens if taxes go up? If taxes go up by even 10%, now all of a sudden, your take home in the future is only going to be $614,000 because more money is going to go to your partner in your retirement, which is the IRS. If you had paid your $4,000 in the beginning, okay, then you're done. You still get to keep your $701,000. That is a big difference in retirement. Very, very, very important to understand. Now, if taxes go down in the future, then yes, you'd be better off postponing the taxes. But again, if you're going to learn 3 strategies to triple your retirement income, then you may want to consider what your taxes might be in the future. You may be in that upper income tax bracket and pay a lot more in the future. Okay, so back to our 4 considerations with growing your money during that growth phase of your retirement plan. We've talked about the rate of return. We've got the fixed, variable, and the index. We've got the average versus the actual. We've talked about the importance of, or the impact of losses. And now we've talked about taxes. We've got taxable, where you're actually paying your money or your taxes as you go, which, by the way, we didn't talk about that a lot, but that one is the worst of all because you're actually paying taxes, and that money that you pay to the government is not compounding interest. So you want your money to grow tax deferred, and then ideally you would want your money to be tax exempt or tax free when you pull the money out. So now let's talk about fees. Okay, so with fees, there is no fees. You can take your money down to the bank. No fees for that. You can stick your money under your mattress. No fees for that either, right? Taxes and fees. Now that adds a lot of expense, right? Yes, taxes could be considered an expense or a fee, okay? Percentage of assets under management. That was what I did the first several years of my career. I put everybody's money under management and I got paid residual income on all of that money under management. But that costs you a fee. You pay a fee for those assets under management. And then there's what we call front-loaded fees, where you pay a little higher fees up front so that you can pay less fees in the end. All right, so let's break it down, okay? Taxes and fees is the red line here. By far the most expensive. By far the most expensive, because as your money grows, if you ever look at your tax return and it says dividend income or interest income, if you're paying dividend income or interest income, that's a tax that's going over here and not compounding interest. That's adding to your expenses. Then we've got fees on the government's money. If you are putting your money into a qualified plan, like we just discussed a minute ago, then you are actually paying fees on your money and the government's money. That's why everyone in the financial industry wants you to put your money in qualified plans, because they earn a fee, they earn a commission on your money and the IRS's money. You know how we just looked at that a minute ago? If you have more money in your account, then you're going to pay more in fees to the financial advisor, okay, or the money manager. Okay, so then, let me go back. And then we have front-loaded fees. Front-loaded fees, tax exempt. Tax exempt. That would be like a Roth IRA or something where you've paid your taxes and it doesn't get taxed in the future. You're actually paying less in fees over time. And then we have front-loaded fees. Front-loaded fees are where you're paying more fees initially, but less fees over time. Now, here's the question. How much does this really matter? Do fees really have much of an impact on the growth of your money? Let's look at 6% in 4 different scenarios. So we're growing our money. We're growing our money from age 50 to 95. We're growing our money at 6% in all of these accounts. Okay? Taxes and fees do make a huge difference because, remember, taxes and fees put your account clear down here. If you're paying all those taxes and fees, you're clear down here at the bottom. If you paid your if you paid your fees up front in what we would call a front-loaded fee scenario, you're going to have the most money. Now, you would think that this blue one is really close to the green one, but remember, that is not all your money. Some of that money in that blue line belongs to the IRS. So the blue line is really down here with the purple line depending on your taxes. So this is not all your money in the blue line. And then of course we have the purple, which would be the tax exempt money. So you can see that on the growth of your money, the account value, the growth of your money, how much you pay in fees makes a huge difference. Okay, let's summarize the growth phase of our retirement plan here. We have the rate of return, fixed, variable, and indexed. We have the average returns versus the actual returns so that we can accurately calculate the future value of our money with the impact of losses in there. And we've got the 3 tax categories to consider. We've got taxable, tax deferred, and tax exempt. Okay? And then we've got the fees. There's no fees, there's taxes and fees, there's a percentage of your assets under management, and then there is also the front-loaded fees. So that's kind of the summary of the growth phase of your money. In other words, there is more to growing your money than rate of return. Rate of return is part of it, but just part of it. It's way more complicated than the rule of 72 and just pulling out your calculator to try to figure out how you're going to retire. All right? Now, which club is best? Which out of all of the strategies, the tax strategies, the growth strategies, which strategy is best? Well, again, it's not about the clubs. It's about the swing. The swing is by far more important. You need several clubs to play the game of golf. It depends on where you're at on the field. If you're 100 yards from the hole or 10 feet from the hole, that's going to change which club you use. It's not about the clubs. It's about the swing. Okay? That is what's the most important. So let's get into the good stuff. This is our distribution phase. So this is going to be this part. So we've already talked about this part, and now we're here. Okay? Doesn't matter how you did it. However you got there, now you're here. So now we're going to talk about this part, from retirement to when you die. And obviously we don't know when you're going to die, so we've got to take all of that into consideration during this phase of our plan. Now, let's talk about indexed growth and income. So, in our previous conversation during the growth phase, we talked about what we call the indexed growth phase. Now, here's the cool part. When it comes time to retire during our distribution phase or our income phase, we don't need to go into a fixed account. Because if we can get double-digit returns and be guaranteed to never lose, then we could still have our money in that indexed strategy, and we could spend money in retirement like the 4% rule. But the difference between this and the 4% rule is that your money is going to earn a better rate of return than the bonds, which is going to give you a 2x income during retirement. Now, yes, I know I promised 3x. I will show you the 3x next, but I first want to show you the 2x. Let's take a look at an example of how this would work. Okay, so in this report, I am showing you how this indexed annuity is what it's called. I know an annuity is a swear word to a lot of people because they don't understand how they work, and they have changed a lot over the years. This is an indexed annuity, no fees, guaranteed to never lose, and you can still get double-digit returns. Great vehicle for that distribution phase or that income phase and the growth phase. So here we have a 50-year-old with $180,000. And by the way, I'm comparing this with a steady 7% return, the last 20 years of the S&P 500, and an unfavorable 7%. So it's kind of a starting out. If you start out with some crappy years, but you still average 7%, but you start out with some crappy years, that's what the purple is. Then we have the S&P in the blue, and then we have just a fictitious 7% steady fixed return. This is our fixed return, but I don't know where you're going to get a guaranteed 7%. This is just to show you how this compares, okay? So we grow our money. We go from $180,000 and we grow our money to the point where we start to withdraw the money. Just like the 4% rule, we are withdrawing the money. Now, if we withdraw the money, look at how much we can get. That's almost 2x the income over a 4% rule, because if we had $500,000 in a traditional stock market scenario, we would only be able to live on about 4%, which would be $20,000 a year. We're getting $40,000 a year because of the rate of return and no losses, right? So now let's kind of fast forward. Let's scroll down a little bit. And we can see what's happening with these other accounts. These other accounts are not sticking to the 4% rule. They're trying to keep up with the $40,000 and they're running out of money. That's why they invented the 4% rule. You can see what's happening over here. But our income from our annuity, our indexed annuity, is still staying strong. Now, we're not keeping up with inflation. We don't have a lot of other benefits that we're going to talk about in a minute, but our account is staying pretty steady. So that means that when we pass away, we leave our family this money here. Yes, you don't lose all the money. Years ago, in the first annuities that came out, if you died, then the insurance company got to keep all your money. That's not what we're talking about. We're talking about taking money out of your account to live on, and you still get to leave all your money to your kids. Just like the 4% rule, but better, all right? 2x on your money, okay? Pretty cool, huh? Now, this is a great example of if you just want to grow your money, but maybe you don't even need an income. I know that when my mom received her life insurance from when my dad died, she didn't need income from that money because she has her real estate income. So she used this particular product to grow her money because more than likely she's not going to need it. But she has her money where it's safe, guaranteed to never lose, and can still get double-digit returns. And then if she dies, that money passes to the kids, okay? So you don't have to draw an income. The income is optional. It's just a good, safe way to grow your money. But as a distribution phase, it's a great way to double your retirement income. Okay, now I promised 3 times your income in retirement, so let's step it up a notch, okay? Let's talk about what we call the protected income value. So what I just showed you was an indexed return that might look something like this. Now, this next strategy that I'm going to show you to 3x your income is where you can choose to have your account value grow a lot slower with a lower rate of return in exchange for what we call your protected income value to grow much higher, okay? You're going to get a much better rate of return, but only on what we call the protected income value. It's almost like monopoly money. It's just a number that is used to calculate your income in the future. This particular strategy has what we call an income rider. What that means is when it's time to retire, let's say that you could retire on 4% based on the age, okay? It's 4% of what? It's not 4% of this number, nope. It's 4% of this number, not 4% of this number, okay? This number doesn't even exist. That was the last product. Now we're talking about a lower account value for a higher protected income value, which gives you a higher income in retirement. Like we're talking way higher, from like here to here, way higher income in retirement, way more than 3x your income. Because now your income is off of this high protected income value number. And here's the best part. Every year that the market gives you a positive return, your income goes up. That's right, your income goes up. It keeps up with inflation and then some. In fact, your income goes up so much that the downside is that your account value drops to zero pretty fast if you live long enough. Here's the other cool part. The income is for life. So when you run out of money, guess what happens to your income? It's like a personal pension, okay? You've got, again, let's just recap. We're going to take a slower, lower rate of return on our account value in exchange for this ridiculously high rate of return on our protected income value, okay? And then we're going to get a personal pension in the sense that we get a guaranteed, when we decide to retire, we get a guaranteed income for your life and your spouse's life if you choose so, okay? Then when you run out of money, your income continues. What's the drawback? Sounds too good to be true? Well, your family might not get anything when you die. However, your income is going to be so much higher than any other option I've ever seen that you could take that extra income and invest it in some real estate, some stocks, or something else to leave, or even life insurance, something to leave to your family as an inheritance. Okay? So that's what we call protected income value and creating what we call a personal pension. Here's the other thing, is if you decide to cancel this account over here, if you cancel your account, this is the number you walk away from. So the insurance companies are using this as like a golden handcuffs. They know that you're never going to want to walk away from this plan, or you're going to walk away with a small amount of money and you're going to give up this huge protected income value. This is really powerful from an income standpoint. In fact, let's take a closer look at how these numbers work, okay? Okay, so here's an example of $130,000 that we're going to move into this indexed annuity that has this protected income value and income rider. By the way, also zero fees, just like the last one, zero fees. If you've ever heard that annuities are really expensive, they're probably talking about variable annuities. The indexed annuities I'm showing you, zero fees. Now, we've got our cash accounts. We've got two buckets. Remember, we have the two lines. We have our cash account, or our lower number, that is really small rate of returns. So our account is growing very slow. The actual account is growing very slow. However, in exchange for these ridiculously high rate of returns with no losses for your protected income value to go from $130,000 to $1 million by age 64, 65 down here, okay? That's some pretty fast growth on your money. Plug that into your Rule of 72 calculator or your compound interest calculator. Try to figure out what kind of a rate of return would you have to earn to grow $130,000 to $1 million. Now, it's only on the protected income value, which is used to calculate your income. Now, they also give you a 25% bonus, which is going to change based on when you're watching this video. These bonuses change all the time. But you could get a bonus when you move the money. So you take your money from your old 401k, you move it into this, and you get a 25% bonus right off the bat. So your $130,000 jumps up to $184,000 right off the bat. Pretty cool, huh? Right? Now, let's look at the income. Let's scroll down and look at the income. We are able to get 4% to start off with, 4% on our $1 million. Our monopoly money, our protected income value, not over here. It's not 4% of $187. No, it's 4% of the big number, okay? Which is, again, this number is only used to calculate your initial income. And then look at the growth of your income in retirement. I challenge you to find any other strategy out there that will give you a greater income in retirement than that. That is way more than 3x. Way more than 3x your income in retirement. The downside is you run out of money pretty quick. After a few years, you run out of money. Now, if you died prematurely before you started to take an income, there is a death benefit that goes to the kids. You're not sacrificing your money. But if you spend the money in retirement, you're going to give up your money pretty fast. Your money is going to go to zero pretty fast. Okay? So you're going to have to take some of that income to invest in some stocks or some real estate or some life insurance or something like that to leave to your kids. Okay? Because your kids aren't going to get anything out of this one. But if it's an IRA, the government's going to make you spend it anyway. Right? So this is a great vehicle to give you maximum income in retirement. Okay, so let's look at some pros and cons. Definitely triple the retirement income on that last example that I showed you. Guaranteed lifetime income. You can't outlive it. Guaranteed lifetime income. Lifetime income for your spouse if you choose. Increasing income to keep up with inflation. So you've got inflation protection. You've got double-digit index returns without stock market losses. Huge benefits there. Tax-deferred growth on the money, even if it's qualified money. If you received an inheritance and you have this non-qualified inheritance money, you could take that inheritance, put it into something like this, and it'll grow tax-deferred. No tax consequences if you want to move money over into something like this. If you have a Roth IRA or a traditional IRA, an old 401k, and you want to move that old 401k over to here, there's no tax consequences. It stays an IRA. You're going from an IRA to an IRA indexed annuity. You don't lose anything. You don't have any tax consequences. Mortality credits. How in the world can the insurance companies provide that kind of an income? It's what we call mortality credits. They know that some people are going to die early, some people are going to live long. That's one advantage that Wall Street doesn't have. Wall Street doesn't have the advantage of some people dying earlier and some people living longer. These insurance companies sell annuities and life insurance, and they're banking on when people are going to die. You can benefit from that in these types of products. And in most cases, there's no fees. Now, it depends on which product. There's lots of products out there, but the ones that I was showing you, no fees. Okay? Now, what are some of the cons? Well, the account value could be zero. Once you start turning on the income, your income or your account could go to zero. That means no inheritance for the kids. However, if your income is that much higher, you could, of course, either live high on the hog in retirement, travel the world, and leave the kids something else, or you could take some of that money to invest it in something that you want to leave to the kids. It also is for a lump sum. This is not for monthly savings. You can't save $500 a month into one of these plans. You have to have a minimum of $20,000. This is designed to move money from A to B. You're moving money from where it's at to here, and that's what these products are designed for. It's not for annual savings. You can't just save monthly into one of these plans.